Welcome to Yahoo Finance Live. I'm Shauna Smith along with Diane King Hall. Happy Friday. Let's get you up to speed on the market action because we're closing out a trading week with significant gains across the board. The Dow up over 700 points. S&P up just about 1.5%. The Nasdaq also moving higher. The rally that we're seeing on the back of the strong jobs report. Also, lawmakers passing the debt ceiling deal, digging down into some of the movement that we are seeing. All 11 of the sectors pushing to the upside. The gains being led by materials, energy, and industrials. Well, Wall Street focused on that May jobs report, sending some mixed signals, though, on the labor market. While the headline number, 339,000 jobs added, blew past estimates, the unemployment rate hit its highest level that we've seen in 7 months at 3.7%. Wage growth also slowing during the month here, Diane. So it certainly looks like a tale of two surveys when you take into account the establishment and what we're hearing and what we're seeing from the household surveys.
Like you had that NFP print that defied expectations, and we continue to see that the NFP print doing well. And just this disconnect, though, between that and the household survey, that's what stands out. Another note that stood out to me is the unemployment rate for black workers. That was higher than the national average at 5.6%. So that really stood out to me. But again, the overall picture on the company side, on the survey side, the NFP payroll side, establishment survey side, you just show this strength there. But, we know that divergence comes also because of how that's counted, right? So one individual can have two jobs and that be counted as multiple notations in terms of the number, whereas when you're doing the household survey, one person, one job.
And the big question here is how the Fed is going to look at this data, right? When you take into account that massive beat that we got on the headline number versus the tick higher in unemployment, and that higher unemployment, 3.7%, comes as the labor force participation rate overall stayed flat. But when you take into account the prime age workers, that did tick up slightly higher here. So maybe partially explaining the uptick that we did see in the unemployment rate. But it all comes down to how the Fed is going to look at this and whether or not the move higher in unemployment, if that's enough for a pause.
But it's definitely giving stocks room to run on this today's jobs data, showing that over 330,000 jobs were created in the month of May. Joining us now for more on the market impact, we want to welcome in Michelle Schneider, MarketGauge.com chief strategist. So, Michelle, let's get right into this in this market reaction. Right now, we're looking at the S&P 500 just really rallying, toying with that level that would kind of take us to a bull market. What do you make of it?
Well, it's not completely unexpected. I think the big lesson to be learned here is all the bearish narratives and all the fear and all the breadth that was talked about when it comes to the debt ceiling. Turned out that the price never really reflected the fears, and people forgot about price. And so we've had risk on environment now for weeks, and we've held critical support. So the question is, are we going to go into a bull market? I would say we're still very much in a trading range. We're just looking outside of the 2023 range so far by the fact that we've gotten over 4,200 in the SPY. But that doesn't mean it can't stop at, let's say, last August high at 4,300 or even go higher. The question is, are we really going to go into an economic growth, or is this simply the sigh of relief that with all the bearish stuff that could have happened didn't happen, and so people are coming back into the market?
Michelle, if we do see the Fed actually raise rates here at their meeting in just under 2 weeks from now, is that going to be enough to halt some of this momentum that we are seeing in the market, at least today?
Well, I don't really necessarily believe that they will hike. I think, as you guys were talking about in the very beginning, the labor report today was so mixed. And basically, you have the Fed funds rate and the CPI rate close together. And historically, May tends to be the peak in rates, that they may actually either pause here or skip. And that could actually present a new round of problems with inflation as we get into the second half of the year. So the Fed may actually be, even with a 0.25% raise, I don't think they're going to do it. I mean, that's just, it's hard for me to fathom it right now.
Michelle, I just want to go back to, you mentioned like stocks have been in this range. You call it, this trading range that we're seeing. But today kind of paints a different picture. I mean, again, the S&P 500 flirting with that 4292 level, which would be the breakout range. There's this phrase that they use on Wall Street, the trend is your friend. So you can't really, can you fight this trend right now?
Well, you're looking at the S&P, but also you have to look at the small caps here, right?
Right.
So today was the first day that the Russell 2000 was able to get through 1800. Now, can it hold? I mean, that's really going to be a key right here. And it's almost like this flip to value and to some basic materials that have been beat up, to consumer staples that have been beat up, even the whole consumer space that really basically held major support but hasn't bounced that much, remains the question in terms of what the S&P and even the NASDAQ, which we know exploded off of AI, can do going forward. So I've got my eyes there because that's really where you're going to get the picture, the real picture of what's happening in the U.S. as far as growth in industrials, manufacturers, and what the consumers are going to do.
Michelle, you just mentioned some of the movement that we've seen in the NASDAQ, a lot of that obviously coming from the rally that we've seen in so many of these AI names. And we take a look at the narrow market breadth. I think a lot of investors out there are trying to question or trying to figure out whether or not we have seen a top in the NASDAQ, at least for now. What do you think?
Well, for now, possibly. It certainly seems a little tired, and the ratio got stretched between the S&P 500 and the NASDAQ stocks, and obviously the race into AI was prevalent and incredible, actually. But overall, it would be healthy to see a correction in NASDAQ. And we actually started to see a little bit red in the semiconductor space today, which I found really interesting because semis were part of the reason why we held on to even staying from dropping precipitously in the market over the last month or so, right? SMH was leading, then NASDAQ caught up, and you have stocks like Apple really going on there. But this question of 10 stocks leading the market, it's healthier if we pull back a little bit there and see the rotation into some of these areas. But that hasn't exactly been proven out because we've had this great one-day rally today. We need more evidence.
Right. We have had this great one-day rally today, Michelle, but you also, again, you have these inflows into tech. You'd say the 10. Bank of America put out a note talking about the Magnificent Seven. I mean, in terms of what's ahead for the summer, are we expecting to see more inflows in these mega cap tech stocks?
It's very possible. Let's put it this way: these companies are leading the charge in AI. Will they get it saturated to some point? To a degree. I like to actually compare it almost to like Tesla in the EV space compared to all the other companies that are making EVs, right? Tesla is just the king, no doubt about it. You can see it reflected in the stock price compared to something like Ford. But that doesn't necessarily mean that Tesla will not come down and Ford will come up. And I think it's the same thing. NVIDIA can sell off, maybe even Microsoft or Amazon or some of these companies that have really been leading the charge. But at the same time, you're seeing companies like Match.com announce that they're using AI. And that's going to be the rub for AI, is that it's really an everyday use that's being widespread and will be more and more adopted. So we could see some leadership change as far as how much NVIDIA goes compared to, let's say, advanced micro devices. But overall, that space will continue to grow over time. But remember, fundamentals and technicals don't always agree, right? So things get overdone, PE, and things can come off. And I still think we have to look at inflation. That's really, people have stopped talking about it. I'm still really focused on it.
Yeah, Michelle, you mentioned earlier just some of the new rounds of problems that we could potentially see with inflation. What more specifically are you anticipating or warning about over the coming months?
Well, there's a couple of things going on now that people should be paying attention to. One is Russia, even though Ukraine has had some victories lately, Russia's talking about pulling back in terms of allowing ships to go into the Black Sea to export grain. And so we have Mother Nature on top of that, which has already put stress on a lot of the grain crops, even in the United States, but also in Australia and Brazil and China. So if you combine those two, that can spark another round of food inflation. With oil, we also have OPEC Plus meeting this week. Could they cut back on supply more? It's possible. But oil has dropped, but it also held key support. X factor, the dollar, BRICS. People think that BRICS is just a fantasy, but it seems the stories get stronger and stronger. Dollar strong right now, but we have to keep our eyes there. And, shipping and supply chain, Panama Canal, today reported that the water levels are so low because of drought that they now have to reduce the weight that the ships are carrying, number one. And number two is the cost of the freight that's going through is rising. These are all things that can bubble up at any time. So I wouldn't get too complacent on the inflation front right now, not to mention the precious metals have really held up pretty well, even if they've come off from the highs.
I want to quickly just get back to oil. We're in really, it looks like a risk-on environment today. You have both WTI and Brent crude up a little over 2% today. So what are you expecting out of OPEC? Are you expecting more production cuts? What are you looking for?
Well, I actually think that, well, there's a couple of other things, by the way. The Saudis are buying cheaper oil from Russia and then selling to the EU at higher prices. So it's kind of an arbitrage there. And maybe that will relax some of their need for that oil money. But it's very possible. Don't forget, they've been warning. They've been saying, bears, be careful because we're meeting. And they're not allowing any press into the meeting, or at least not the big press release of people like a Bloomberg or a Reuters. So at this point now, I would say we have to watch price. It's always about price, right? That's what we've learned in this lesson now to this point. And now if we can get over $80 a barrel, particularly in the Brent crude, I think that means that whatever OPEC Plus decides to do, we're starting to see constraints on supply. And everybody was discounting China as a big demand, but China isn't not exactly as bad a shape as people would like to think. China is very forward thinking, and they could come back also and put a strain on that supply with higher demand.
Yeah, oil prices moving up just over 2% here ahead of this weekend's meeting. Michelle Schneider, thanks so much. Have a great weekend.
Thank you, too.
We are also keeping an eye on the bond market on the heels of that monster jobs report. Jared Blickery is here with a closer look. Jared?
Yes, I want to show you what's happening in the bond market first, and then we can talk about equities. There were no big hiccups today. I was really closely watching what the bond market is expecting the Fed to do in a couple weeks. Not that much change from before the report. So the bond market is expecting the Fed to stand pat, and those chances were about 0.8% yesterday, 80%. They're only down to about 70% today, which I find remarkable in light of the fact that we got a Fed Whisperer article out today from Nick Timiraos over at the Wall Street Journal saying the Fed now has cover to increase the rate at its next meeting. So here's a 10-year T-note yield. This is year to date, and we can see we got a rise off the report, but nothing to ruffle any feathers here. I was also just looking at the 13-week T-bill yield, which closely tracks what the Fed does with this benchmark, but not seeing any big hiccups there either. We got to talk about volatility. And with respect to the bond market, we have the VIX in equities, we have the B of A move index over in bonds, and we are seeing a tick down, 2 ticks down in bond market volatility that is supportive of equities. And now I want to show you what's going on with the VIX. We broke down to new multi-year lows yesterday, and we are continuing to fall today. We're also seeing that in the second derivative of the VIX of the VIX, that is heading down as well. And you put all of this together, and I look at what's happening with equities today. The Dow is basically double the NASDAQ. When's the last time we've seen that? It's kind of a new strength trade that we're seeing here. The dollar is up, yet we see energy, materials, industrials, consumer discretionary, all of those are outperforming. You take a look at the top three, really interesting to see cyclicals outperforming. Maybe they can continue. To see that huge breakout today in small caps, I find encouraging, but we can't get a CPI print that disturbs the market too much.
This is true.
Yeah.
Absolutely. That would certainly change the direction, Jared. All right, Jared Blickery, thank you so much. Meanwhile, we're just getting started here on Yahoo Finance Live. Coming up, Amazon reportedly in talks to provide low-cost wireless services for Prime members, what it means for the big carriers and for Amazon ahead. Plus, the AI boom rolls on. We'll discuss how one company is using AI to help people in their job searches. And the battle of virtual reality headsets is heating up. But what's the missing piece for Meta and Apple? We'll discuss later in the hour. Stay tuned for more on Yahoo Finance. The U.S. labor market showing resiliency as the economy added 339,000 jobs last month, blowing past expectations. However, the latest numbers do little to clarify the Fed debate over whether to pause rate hikes in June. This all while the Fed continues in its efforts to cool inflation. Here with a deeper dive on the current economic picture is Nationwide chief economist Kathy Bostjancic. Kathy, let's get right into this. First, let's do like a fresh analysis. How do you read the tea leaves on this jobs report? Of course, we had the household and establishment survey. One side looking great, the other side. What's your take?
Yeah, happy to be with you, Dan. It can be confusing. Clearly, they are two different surveys. The non-farm payroll, though, in terms of the employment count, tends to get more attention, and it should. It's a bigger survey and more stable. And that said, when the two surveys disagree or there's a conflict, sometimes it's a sign of a turning point. That said, it looks as if the labor market still remains incredibly strong. The number of job gains, and it was widespread. And wage growth, even though the headline number, which includes all workers, was up just 0.3 on the month and allowed the year-on-year rate to ease a bit to 4.3% before 4. If you look at production and non-supervisory workers, it was up 0.5%. So that's quite strong. And the year-on-year remained at 5%. So there's still a lot of wage gains, especially with the non-supervisory workers, and they're really spending, right? We're seeing consumer spending remain quite buoyant.
So Kathy, then what does this mean for the Fed? It sounds like, at least maybe from your perspective, that it could possibly make sense to hike later this month. Is that right?
It could, although, I mean, they are supposed to be data dependent. If we just look at the data that have been released, that would argue for tightening rates on June 14th. Now, of course, we will get the June CPI inflation report, so that's important, and it makes sense to wait to see what that is. But really, what Fed officials have come out and said mostly is that they're looking to skip a meeting and, if need be, tighten in July. So they really came out of the last meeting thinking they wanted to pause, and the data have gone against them essentially, and they haven't really wanted to change their viewpoint. They want to assess the economic landscape and see more data. And that puts it at odds with data dependency, right? We're now living by their short-term guidance.
Kathy, I want to ask you, one piece of the report that stood out to me was the Black unemployment rate, which rose to 5.6%. So that pushed up the overall unemployment rate. Is there cause for concern seeing a number like that?
Well, when you do see increases in unemployment rate, whether it's different demographic sectors, which of course matters greatly, or even just the overall number, which went up 0.3, that historically has been consistent with recession. But we've been in this range, a lot of those measures, even for Black Americans, that unemployment rate has sort of been in this range, since if we go back to early last year. So it's not alarming at this point. And I think what we're seeing from other measures like the job openings data, that there's still just a lot of demand for workers. And maybe it's pulling them. Maybe they're unemployed, but it's very temporary because they can then quickly find another job. Maybe not exactly what they were doing before, but maybe on the service side of the economy.
Kathy, is there anything recessionary about this print?
Well, I think you really have to stretch to get there. I would say overall, no. I would say that, employment, shows that we are not in recession, and not about to go into recession. Now, keep in mind, though, the employment measure and job growth is a coincident indicator. Initial jobless claims are really the leading indicator. But even there, we're not seeing a lot of weakness. The labor market's slight, but not a lot. So, I think what it does is tell us that we're probably going to have strong growth through even the third quarter. And we have to look to the fourth quarter. We haven't abandoned our call for recession, but we do think it's delayed. And because these leading indicators still indicate an economic downturn, and these are tried and true indicators, but for the meantime, this job producing engine is still really humming along.
So, Kathy, you said you haven't abandoned that kind of base case expectation for a recession. But you're seeing it as delayed. Is this a 2024 expectation now?
It is tough to call the timing just because we in the forecasting, economic profession have really been surprised by the staying power of the labor market. And therefore that feeds into consumer spending. But our view is, by the fourth quarter, we'll start to see some of the cracks emerge and the recession start. We do think what we're seeing is this kind of last blow off of buoyancy in the labor market and consumers because the summer travel season particularly is heating up. So and there's also all that pent up demand and also savings that were accumulated during COVID and related to COVID. So for now, you still have that staying power, but as long as inflation continues to only gradually slow, and let's keep in mind, even if the Fed skips June, they could come back in July and tighten, and that's going to raise borrowing costs for consumers and businesses.
Okay, well, to skip, pause, or hike, that remains the question. We'll certainly see if there's a summer surge that changes anything within that picture. Thank you so much, Kathy Bostjancic, Nationwide Chief Economist, for joining us this Friday. Happy Friday.
My pleasure.
Well, the May jobs report showing construction employment jumped in May, with the industry adding 25,000 workers. Yahoo Finance's Danny Romero looking into this. And Danny, this is a sector that has really been struggling to find the workers that it needs.
Yeah, so construction jobs aren't going anywhere. There's still this really strong demand to hire construction workers, specifically on the residential building side of things. About 2,400 jobs were added for residential building in May. So really signaling that manual labor is here to stay. Home builders have struggled to attract talent, retain these workers. So it really suggests that they're likely not going to get rid of these workers, even under a weaker housing market. Plus, employers have also scaled back some of those job listings specifically for construction compared to a year ago. Right. So home builders are really focused right now on finishing up those homes that are under construction and then starting new ones. We've kind of seen that in the data. Also, the U.S. still has a record number of homes under construction. So that adds a little bit leverage to this picture right now for construction workers. If we take a look at the average hourly earnings, construction workers are currently making about $36 and change. That's about 5% higher than it was a year ago. But the industry still faces major headwinds ahead. There's still a lack of labor candidates. I spoke to quite a few developers that say that they are having a really hard time finding candidates. Sometimes it takes them 6 weeks to 3 months to find one candidate. And so that prolongs also the onboarding process as well.
And also potentially then prolongs the inventory issue that we do have in the housing market today. Danny Romero, thanks so much. Well, coming up, one key issue tied to AI is whether it will take jobs. But our next guest is saying that using artificial intelligence could actually help you find your next gig. More on that when we come back.
Amazon Prime members might be in for a new perk, phone plans. Yahoo Finance's Dan Howley has this story. Dan, I need to know, am I about to switch?
That's apparently what seems to be going on here. This is according to a report from Bloomberg that Amazon is talking to various carriers about potentially offering unlimited wireless deals for as little as nothing. It would be wrapped into your Prime benefit. Could be $10 a month, could be nothing, and could be wrapped in. There's really no firm understanding quite yet. This is still in early discussions, according to this report. And we had heard from T-Mobile specifically that they are not interested or they're not speaking with Amazon at this point. We have them saying Amazon is a great partner to T-Mobile in many areas, and we are always interested in working more closely with our crosstown neighbors in new ways. However, we are not in discussions about inclusion of our wireless in Prime service, and Amazon has told us they have no plans to add wireless service. So that seems to throw a wrench in this kind of conversation. But if they did manage to do this, you can imagine that it would be incredibly difficult for the likes of AT&T, T-Mobile, Verizon to really continue to operate at the pricing they currently do. This is good for Dish Network, though, because Dish instead of Dish Network, because they're basically trying to get their own wireless network up off the ground. You remember back when we had Sprint purchased by T-Mobile, Dish picked up some of the subscribers there, and then they're trying to be a kind of fourth offering. Right now, it's still the major three. So we just have to wait and see if this does eventually become a new part of Prime and a better reason to sign up.
Well, Dan, that was my question, just in terms of, do you think that this makes sense potentially for Amazon to push into this sector, and why?
It does. I think if they can get a bigger list of offerings for the price, it's $139 right now a year. You have Amazon Prime Video, you have the ability for same-day delivery, you have Prime delivery. So I think if you can get another benefit like this, it would just kind of entice more people to want to come back in or stick around permanently. Because okay, maybe you sign up for Prime around the holidays. Maybe you sign up for Prime when the boys come out on Prime Video, and then you ditch it. Well, if you have your wireless carrier as part of this, you're going to lose that cyclicality. People will just stick around permanently, and that could really be something that I think Amazon takes as a boon. And hey, I mean, wireless prices are pretty expensive. If you can wrap that into $139 a month plus the Prime delivery, I take that.
Same. Dan Howley. I mean, and when you said T-Mobile's not a part of it, I'm like, that's fine. I'd be switching from them. So thank you, Dan, for that insight.
Well, more people are looking for jobs. Recent data from recruiting software maker ICIMS found that job application activity is up 31% over the past 15 months. And for those looking to land their dream job, well, artificial intelligence may be one way to help you stick out from the crowd. For more on this, we want to bring in Victor Schwartz, CEO of Sonara, which is an AI job search platform. Victor, it's great to see you here. So lots of talk about AI, how it could be taking people's jobs. Let's talk about how it could maybe potentially help someone find their dream job. What do you do, and why does this make sense for job applicants to use?
Yeah, so AI has historically been part of the narrative of taking away jobs. That's no surprise. Of course, with things moving faster than ever, I think that talk has been at an all-time high. What I'm really focused on is using AI to really empower job seekers to be successful in the job search by giving them a tool that fundamentally transforms how they think about it. So the way it works is we use AI to operate almost like a talent agent would for a movie star. We understand you, understand who you are and what you're looking for. Then our search engine looks at 10 million job listings posted online, identifies the most relevant ones every single day, and automates filling out the applications on your behalf using generative AI. So it's constantly operating in the background and really empowering job seekers to start the job search from getting an interview in their inbox rather than needing to spend all that time just sending out applications.
But Victor, okay, to your point, sometimes this generative AI, I mean, we're in the early stages of this, can make mistakes. Like we had something earlier this week that we talked about, like a legal case where there were all these errors found in it. So how do you deal with that? How do you address the potential for mistakes with something like this?
So it's a problem that's been around since the dawn of machine learning and really software systems. anytime you're learning behavior, you're not always necessarily learning the right things. And so, of course, you see errors coming out in how generative AI is, producing content, and we're not immune to that. What we've had to do, and the reason I've been working on this for several years, not several months, is in order to get this right, you really need to deeply understand the use case, understand the intentions and goals of the customers, and build in the right guardrails in order for them to be successful. So we've used AI broadly across our system to really be very smart around what is being asked, how do we interpret what I need to know about you as a job seeker in order to answer it, and then actually producing high quality answers that are true to your experience with the right guardrails in place to catch errors, giving the right transparency and control to job seekers to essentially be an amplifier for their desires in this job search and representing them as well as they would like to be.
Victor, is this a case maybe for someone just across the board, no matter what their experience is? Clearly, I think it would give someone an advantage if they're just coming out of college. But what about someone who has 10 or 15 years of experience? Does it help them as well?
So what I recommend is, the same way when people are going to college, you might work with a college counselor and they're going to help you put together a strategy. You have the dream schools and you have the safety schools and the ones in between. And what I recommend is, regardless of where you are in your career, you need to have a balanced strategy of filling out cold job applications online, networking, upskilling, reaching out to people. There's a series of activities you need to do. And applying online, regardless of where you are in your career, is a critical aspect. What I've found is people spend more than 80% of their time job searching, just going on LinkedIn and Indeed and, applying to as many jobs as they can. And that prevents them from spending time on other higher value activities, like you mentioned, like networking and leveraging your network. People are spending so much of their time, and critically, not just time, but energy in this process of putting yourself out there over and over again and feeling demoralized, because when you're sending out hundreds of apps, you're getting rejected or ghosted by most of them. That can really lead to a very painful process. What we're really trying to do is hone in on that part of the process and free you up, regardless of who you are, what your background is, to spend time on those other higher value activities.
So to your point, yeah, Victor, it can be a grind when you're going through that application process. I've done that. So I kind of have a two-pronged question for you. Why can't I just use LinkedIn? And also talk to me about the numbers that you have that support your case for incorporating AI more in your job search. Like, how much more efficient is this going to make me?
So AI fundamentally adds new capabilities to humanity, right? And there's a reason you're seeing it transform every single industry, and it will continue to accelerate. AI can be used in so many different ways in the job search, whether it's helping you understand how to optimize your resume, helping you figure out even which jobs to apply for, helping you write a cover letter, whatever it is. One aspect that it hasn't yet reached is this process of actually filling out the applications. And I think that's the fundamental shift here. And the reason it's different is we are removing this emotional skin in the game from the process. So it's the difference between LinkedIn one-click apply and zero-click apply. You don't need to spend time laboring over researching a company, figuring out whether you perfectly fit the skill set if 99% of the time you're never even get a response. What we're doing is figuring out how to operate on your behalf and enable you to do more in the job search, thereby essentially increasing your leverage and giving you the best chance of success.
Hey, Victor, what do you think that this could potentially do just for HR departments, anyone that's in that job placement industry out there, just in terms of potentially replacing their jobs? Is that a risk, given the fact that AI could really just streamline the process that currently takes many people to sift through those applications?
Yeah, so, the way I think about it is it does fundamentally change the role. The same way that we are essentially becoming the AI agent for job seekers that's constantly operating in the background, finding and applying to jobs for them, HR departments will continue to leverage AI tools more and more to remove a lot of the grunt work that they have to do. Most of the time, in my experience in talking to those people in HR departments, is filtering through resumes, just trying to do a lot of grunt work. And if they can spend more of their time on actually speaking to more qualified candidates, and actually not spending their time just doing that grunt work of reading resumes and all the other work associated with that job, they're going to be able to get a lot more leverage in their career and be able to do a lot more. It's a traditional answer to automation and AI, but I think it holds true here. And I think yes, it will absolutely change their job. And yes, they need to be aware and on top of how it's changing. But I think it creates an opportunity for people to go much further and become super recruiters, the same way they're talking about everyone becoming a 10x engineer. Everyone could become a 10x recruiter just by leveraging AI.
Or how about a 10x candidate, I suppose? But Victor, I got to ask you a question. Yeah. You talked about removing some of the emotional skin in the game. I understand removing the grunt piece. Neither side really likes that, whether you're a candidate or on the recruiting side. That's just annoying. But the emotional piece of it is kind of often how you connect and can be that piece that takes you through the door versus someone else. How do you do that? Like if you're looking for a customized cover letter or something like that, how do you keep that as a part of the equation when you're talking about AI?
Yeah, so historically, the industry at large here, as I've gone to conferences and really understood how people think about it, people have used lengthy job applications as a way to essentially qualify candidate interest. They said, hey, if I can get this person to spend 30 minutes or an hour on this job and answer, 10 custom questions, then I'm going to get to know them. And that means that they care enough to, really be serious here. I'm challenging that. I'm saying what happens is you fill out an application, you spend a lot of time on it, you send it out, that company's going to get 10,000 or more, resumes. They're going to filter out 99.5% of them. And then they're going to spend time on a few that, they're going to actually call in for an interview. I don't understand why this industry thinks that job seekers should be wasting all that time up front, let alone the emotional aspect of it. It's just a lot of wasted time. Like you're just filling out the same information over and over again. That doesn't have to be you. And in my experience, one doesn't differentiate in, really in the application almost ever, because that's just not how the industry is set up. You differentiate once you actually get an interview. And yes, there are things you can do to maximize response rates. We're building that into our process, but that's the point. People shouldn't have to, have a master's degree in job searching to be successful in their career. I've seen some of the smartest people in my life be willing to take anything they can get or get nothing because they don't understand how this process works. We're building in that understanding into our system and raising the tide for all boats. Everyone is going to benefit from this. And yes, it's going to change the industry, but in my opinion, deeply for the better.
I do like that pitch there, Victor. Victor Schwartz, we're going to have to leave it there. We appreciate you, Sonara CEO. Thank you so much for joining us this Friday.
Absolutely. Appreciate you having me.
All right.
Well, we've had Betamax versus the VHS and PlayStation against Xbox. Now, are we about to enter the new tech battle with AR/VR headsets? We are just days away from a rumored release of the Apple's first console, with Meta already leading the charge, unveiling its Quest 3 model this week. Here with more, we want to bring in Ali Garfinkel. Ali, what do you think? Because I'm skeptical about whether either is going to take off.
Well, to that end, Shauna, the reality is this is the moment that could change VR forever. The question, of course, is, will it? By how much? And yes, VR is on a growth trajectory. People are expecting VR as a market to be worth about $52 billion in 2027. But to me and a lot of experts I've been talking to, there's still this sort of major outstanding question that I think you were referring to, Shauna, indirectly perhaps, which is, what are we supposed to do with these headsets? Now, I'm being a little flip. The answer is gaming. But the reality is, there still hasn't been a hero app, an app that absolutely everybody, no matter who you are interested in it. Now, I actually brought you a prop to demonstrate the power of the hero app. This is my Nintendo Switch. I love my Nintendo Switch, and I actually went out and bought this for one reason and one reason only. It was to play Mario Kart. Now, I recognize that this sounds crazy and is a little jokey, but actually is true, and I think important to the adoption of these things. So what is to be done about it, right? Meta held its gaming showcase yesterday and announced a bunch of new titles specifically focused on gaming, and a lot of them really had these really high-profile names, this great IP behind them. For instance, we saw them announce the possibility of Stranger Things VR. We also saw them announce a new Ghostbusters game. And while that stuff is really important and really interesting and fun and exciting, are you running out to buy that? I don't think so. I know I've talked to a lot of experts who said, Ali, maybe you're being unfair saying they're throwing things at the wall to see what sticks, but it certainly is that. They're really throwing out a lot of options for gamers and people who want to use VR sets, but none of them have fully hit as a unanimously agreed upon hit. So what am I really watching for on Monday, Shauna? How does Apple want you to use this headset? What does Apple want you to do with it? What does it want you to play with? What are the apps it's featuring? Because to me, that's going to make the really big difference. and is going to determine if I want to run out and buy it, like I say did with this Nintendo Switch.
Ali Garfinkel, I love that you brought the prop today. The Nintendo Switch.
It was in my bag.
I love it. I love it. I love it. No, that's fun. That's fun. All right, Ali G, thank you so much. Coming up, investors in the luxury retail market are worried about a slowdown. We'll check in on the state of the sector when Yahoo Finance returns. Shares of EV makers riding higher today on news that China is set to extend tax incentives for electric vehicles. Yahoo Finance's Praz Subramanian is following the story and joins us now for more. Praz?
Yeah, good news for these Chinese EV makers like Xpeng and Li Auto and NIO even. China's going to potentially extend some of the tax breaks that they have for these EVs. So usually there's a 10% tax on new cars. They have kind of ended that for a while, and they're going to restart it in 2023. They extended it to the end of the year to give a little relief for these automakers. Now there's talks it might extend for over 4 years. So big deal for cars in the 300,000 yuan range, or like $42,000. So non-luxury EVs. They want to kind of stir the kind of incentives there. Because car sales are decelerating, actually. Believe it or not, China's the biggest market, decelerating overall compared to a year ago. But EV sales are still higher, but not as high as they were last year. So there's a little bit of concern there. But they're trying to stir that up. But good news for EV makers going forward.
Indeed.
Speaking of some EV makers, there's some buzz about Volkswagen's new or revamped microbus. Yes. Are you a fan? I've always been skeptical of it.
I know.
So I've always been, kind of like they're cute, they're interesting, very odd cars.
That is a good way to put it.
Odd with the engine in the back and the floor of the van, really tiny, like microbuses. So they're bringing that back. They announced it about a year ago, but this is they're announcing today the 3-row version for just for the North American market, because it's such an important key market demographic there. 3-row SUVs, this retro style sort of car here, dual motor or motor in the back, really cool like fake air vents in the back, kind of harkening back to when the motor was back there. The both power sliding electric doors, quirky little light bar in the front. So yeah, there you see part of the window right there. So really a fun design there. I think it might sit well here in the U.S., especially with 3-row customers.
Yes, it has a very retro kind of look to it, but made for a new age.
Yeah, a lot of fun colors too. Yeah.
Indeed. All right, Praz Subramanian, thank you so much, Praz. All right.
Well, investors in luxury retail market are worried about a slowdown. Shares of European stocks LVMH, Hermes, and Gucci owner carrying all fell earlier this week on some signs of weakness in the U.S. consumer. And then, of course, there are also some concerns out there about demand in China and whether or not that is going to fade. Joining us now, we want to bring in Pauline Brown, former LVMH chairman of North America, also author of Aesthetic Intelligence. Now, it's great to see you here. Lots of questions just about the long run that we've seen in luxury retail, whether or not that's coming to an end. Pauline, what do you think?
So all good things do come to an end. I think luxury will continue to outpace non-luxury. It will not grow nearly at the rate that we've enjoyed for the last couple of years. In fact, in 2023, it's expected to grow 7%, not a bad growth figure, but that is less than half of what it grew in 2022. So clearly a slowdown or deceleration.
Pauline, Diane here. I want to ask you, let's talk a little bit about China. So LVMH chief Bernard Arnault is reportedly set to visit China later this month. Now, in terms of the numbers and how much China accounts for the luxury market, I mean, we've seen that Chinese customers expected to account for about 60% of luxury growth. What do you think this signals with him planning to make this visit?
So for the last 20 years or so, China has contributed the most of the growth that we've seen in global luxury. Going forward, it's still, by virtue of its sheer size, going to contribute a lot. And this is coming off of a rather anemic period in luxury sales in China. So I do think that we'll see some pickup relative to what we've seen recently. I also think Chinese consumption of luxury will compensate to some degree with a bigger slowdown that we see here in the U.S. But I don't think, once again, that it will nearly approximate what we saw in years past. It is maturing. It is leveling out. Chinese consumers are becoming more discriminating, and they're also changing where and how they buy their luxury.
Pauline, what do you mean by that? What are some of the shifts that you're seeing there?
One of the biggest is historically more than 2/3 of luxury sales to Chinese happen outside of mainland China. Largely in Europe, but even in other parts of Asia, like Japan and Korea. Because of the restrictions, the lockdowns in China, that has shifted largely to domestic. Now it is opening up again. So the good news is the Chinese will start to travel, and that will be a nice surge for sales in Europe. The bad news for the luxury players is that products sold in Europe are on average about 30% cheaper than in China. So they're not going to see quite as much of the top line gains as when they were selling to Chinese domestically.
So Pauline, to that point, so not just tourists coming from China, and heading to Europe and finding better prices that way. I mean, you see the same thing with American tourists. We have heard a little bit of buzz about some of these luxury handbag makers and luxury companies changing how they price. What are you expecting to see in terms of pricing to, I guess, combat that pattern or that trend?
So there's been a lot of inflation, and I think most of the players have taken their price to a level that is not sustainable. I mean, when you look at the appreciation of the price of an average, say, Chanel handbag, Dior handbag, just in the last 5-6 years, it has really extended itself, and it's becoming unaffordable to an aspirational buyer. So point number one, while some of the growth was fueled by these price increases, going forward, I think it'll have to come from real, volume increases. And that's going to be tough. That's going to be tough, especially when the aspirational shopper doesn't have quite the means and the capability that they did a few years ago. The economic conditions are a lot more challenging now. The uber wealthy, who do account for a healthy share of luxury sales, they'll continue to buy selectively. There are brands they favor, there are categories they favor, but they'll continue to spend.
Pauline, who's best positioned then? Is it that very, very top line, LVMH being one of them? Are they a type of brand that could potentially continue to succeed given all of that uncertainty?
So I think any one brand, however strong the brand, is going to be challenged. The reason LVMH always outperforms a sector is because it is so well hedged. It's geographically dispersed with more than 70 brands. It's dispersed across different marketing segments. It has even a very broad sort of definition of luxury So what luxury is within the LVMH context at a brand like a Loro Piana or some of their jewelry, Bulgari, average price point really, really high. And then on the other end, you have Sephora or Hennessy or some of the other wine and spirits brands, which are still expensive for their categories, but they are affordable to the mass market. So that degree of diversification will insulate it in any given market and any given segment challenge.
So, Pauline, I want to extrapolate your point you made about pricing, and that, we have seen some of these bags, and whether it's Chanel we're talking about or Louis Vuitton bags, et cetera, just head to levels we've never seen before, and seeing some of that come down and compensate for that with volume. But one of the things I want to talk to you about is, could we see a shift in terms of style? Because I've seen some talk about how people may be looking for more of a classic look and not necessarily logos emblazoned on everything. Is that one way some of these luxury brands are seeking to, say, both distinguish themselves, procure more clients, and retain loyal clients?
Well, the pendulum is always swinging from one end to the other. And we've just come off of an era that was very loud, very focused on streetwear, on big labels, on first-time luxury buyers who were, whether it was people who had IPO'd in Silicon Valley or who had made their fortune in mainland China. So a lot of first-generation wealth was created, and that is generally attracted to a different kind of style sentiment than people who are more, let's call it, lifelong luxury buyers. And so, yes, I think that the trend is moving back in the other direction, toward quality, toward sustainability, and by that I mean buying things that you'll wear for years on end, not of the season, and then also sustainability, just in terms of the sort of conscious capitalism, the idea that these brands are made to last, that they are made by artisans. The artisans are fairly paid. The ingredients or materials that went into it are properly sourced. There's a lot more of that questioning that's going on than a few years ago. But those stylistic trends do go in cycles. And then within segments, what I'm seeing right now, because Americans and non-Americans are traveling a lot more, having been sort of pent up in their homes for a few years, they're buying things that are conducive to their travel. So clothes, for example, that travel well, or shoes that you can walk while you're traveling. As opposed to what they might have bought, 5-10 years ago that would be good for the office or other forms of luxury adornment. People also are having a lot more events and celebrations. There's a lot of weddings going on that were staved off. So we see more formal wear. Where we're seeing softness is in the handbag segment, in part because it was on such a growth trajectory for a few years that I think it's kind of saturated.
A big reversal from what we've seen, at least what we saw in 2022. Pauline Brown, former LVMH chairman of North America. Thanks so much.
Thank you.
Well, coming up, we get you set for the final closing bell of the week. Gains across the board. The Dow still up just over 700 points. We'll be right back. And that rounds out today's trading week. Again, we're ending the day with pretty strong gains. The Dow up just slightly shy, but just right around 700 points. S&P up just about 1.5%. The NASDAQ adding to the momentum from earlier this week, closing up just about 1%. All three of the major averages closing higher for the day, also closing higher for the week. The NASDAQ now up 6 weeks in a row, marking the longest weekly streak that we have seen for the NASDAQ since 2020. Again, the S&P closing well above 4,200, a key support level that the street has been watching. Let's take a look at some of the big movers of the week. First up, we got to talk about Lululemon getting a lift today. Shares closing up just over 11% higher after blowing past the street's expectations in its latest quarter. The retailer also raising its full year net revenue outlook. This coming as welcome news to investors amid a very choppy consumer environment right now for retailers here. Diane, when you take a look at the results here from Lululemon, a lot of that strength coming from overseas in China, where
rebound.
Lululemon has a lot of runway left to go.
Yeah, I mean, there was a 79% surge in China. There was even a surge here in North America. I mean, up 17% here in North America. I was a little bit surprised by that. I used to be a big Lululemon fan. I can't remember the last time I've been to Lululemon, but clearly I'm not the
What have you replaced it with?
I know, that nothing. I mean, I have a good collection of leggings. I mean, Lulu lasts for a while. So, I mean, you know, they did well. They're being rewarded for that growth there, that China story once again there. On the flip side, though, we have SentinelOne shares sinking in today's trading session, down more than 30%. This after the cybersecurity company slashed its full year revenue outlook. The company citing continued macroeconomic pressures impacting deal sizes, sales cycles, and pipeline conversion rates. So really getting roughed up in today's market. It's clearly a different story than the broader market that we're seeing with SentinelOne.
Yeah, certainly is, at least for today, with shares closing off just about 35%. When it comes to the street's reaction, Stevens downgrading the stock to equal rate. Morgan Stanley was also out with a note saying that, quote, investor confidence in SentinelOne is going to be hard to win back, at least for now, given some of those trends, Diane, that you just mentioned. But you're right, the macroeconomic environment right now, certainly the company sees that impacting deal sizes, sales cycles, a little bit worrisome here to investors. We also got to talk about some of those AI plays. Shares of NVIDIA giving back some of that early momentum that we saw earlier this week once the stock briefly cracked above the $1 trillion market value here. But we did see a little bit of a pullback across the board. C3 AI was one of the names under pressure this week following its earnings report. And just to point it out, though, that was a stock that was up over 200% year to date going into the report. So we're seeing a little bit of a fallback here in terms of the fundamentals and where these stocks have been trading.
Yeah, I mean, that looks just a little bit like profit taking. And we know this AI hype is really more than hype. We talked to investor after investor. It's fueled tech fund flows. We saw that in a Bank of America note today, talking about record weekly inflows into these really just big names within the AI sector. And again, NVIDIA, that just looks like profit taking today. And I mean, we continue to see we're really at the beginning of this AI play.
Yeah, certainly. That seems to be at least a consensus from analysts following their earnings report last week. Indeed. All right, well, the debt ceiling crisis has been averted. The Senate passing legislation to suspend the debt limit by a 63-36 vote late last night. Yahoo Finance's Rick Newman looking into this, figuring out what this all means for President Biden. And Rick, you say it's a big win. He's coming out of the week in pretty good shape.
Well, I think the best news is we don't have to devote any more airtime to it here
at
Yahoo
Yahoo
Finance. Yay. I think we're all celebrating that. It's a relief for markets, obviously. We're seeing that the last couple of days. I think this unequivocally is a win for President Biden. He said all along, I'm confident we're going to reach a deal. Don't worry about it. And that's exactly what happened. Now, if you want to get into the weeds, which, some of the political geeks want to do, Biden did change his story a little bit. He said at the beginning he was not going to make any concessions in order to get the debt ceiling raised. And then he did make some concessions. But I don't think anybody really cares much about that. They're modest spending cuts at best. Some of them may not even happen. And now we have the debt ceiling raised all the way to the beginning of 2025. So we will not have to deal with that during a presidential election. And then it depends, obviously, on who wins in 24 to see what happens with the debt ceiling the next time around. But we got through it. And meanwhile, look at this jobs report for today. I mean, it's fair to say Biden's having a good week. However, we know that his approval rating is meager. It's down around 41%. And the big question is whether he can translate what is pretty good political and economic news into a bump for his own approval rating. And that has been a challenge for Biden. I'm not sure whether it's a messaging problem or his age, just concerns about his age just override anything positive about the economy, or if inflation just trumps everything at this point. But Biden ought to have a pretty good message, and it just doesn't seem to be getting through.
Yeah, Rick, why don't you think it's getting through just in terms of the strategy, the messaging? You're right. If you look at the track record, it is pretty impressive, yet it hasn't, and it still does not seem to be resonating with voters. How do you see, or how would you suspect that messaging changing then over the next year and a half?
I think some of it is subtle. Biden has turned out to be a bit of a different president than I think many of us expected. He has been politically effective. He got a ton of stuff of his legislative priorities through Congress in the first 2 years when Democrats did control both houses of Congress, even though they just had that tiny one-vote margin in the Senate. He got trillions of dollars of programs through, which is, I think, more than any other president. You'd have to go back to, I don't know, maybe Bill Clinton in the 1990s. But yet he's just not, people just don't like him that much. I think a lot of this is modern day politicking with the importance of viral memes and everything. And, what was really one of the biggest stories this week, Biden tripped on stage while giving out a diploma. So those types of problems are going to dog him into 2024. And let's see if he can change the story a little bit.
I felt so bad for him watching that trip video. That's something I would do, tripping over the sandbag in front of everyone. You had to feel for him that moment.
I would too, but look, he's 80, and when you're 80, a fall is different.
Yeah, very different. All right, well, Rick Newman, great to have you. Thanks so much. Have a good weekend.
Bye, guys. You too.
Meantime, the Hollywood writers' strike entering its second month, and with production on shows and movies at a halt, the financial consequences are rippling through the economy in Los Angeles. Akiko Fujita has a closer look straight from the picket lines in L.A.
We deserve to live here with dignity.
1, 2, 3, 4. Stop the strike and pay us more.
1 month on, no resolution in sight. The battle between writers and studios at a standstill.
I'm out here because the companies are refusing to treat us like people, essentially is what it comes down to.
More than 11,000 members of the Writers Guild remain on the picket lines. Those like Haley Harris off the job to ensure job stability in the future.
Are you worried the longer this continues, what this means for your way of living? If you're able to survive, do you have enough savings?
Well, unfortunately, the companies have trained a work population that is very used to being unemployed, that is very used to picking up second and third jobs just to make ends meet.
The strike has jolted every facet of the economy here. Production has been shut down, business stalled. The fallout estimated to top $3 billion.
Baby carriages. Baby carriages are hugely popular. They're very specific to a certain time period.
Pam Elyer's prop house History for Hire builds the vision for Hollywood's biggest movies.
This was an Anchorman, which we really loved doing. This is the style that we used on Fableman. This is a prop that we used on the first movie we ever did, Platoon.
She's already laid off 4 people.
There's not a lot of other options for us. So what we do during this time when we're shut down is we work on our stock, we maintain it, but every week we're losing money, every month we're losing money on this, and we really estimate the strike will at least go on to the end of September, possibly the end of the year.
It could get worse. Roughly 38,000 jobs were cut during the last writer's strike in 2007. The economic loss, $2 billion, according to the Milken Institute. Today, California already has one of the highest unemployment rates in the country.
I'm a big believer that you solve problems not by stopping forward motion, that you solve them together and that we all work on it. May the writers get what they want and what they need, but there's all these below the line people that are not going to benefit from this strike, and it's just going to cause them a lot of pain that will take them months and years to catch up from.
The writers say they're ready for the long haul.
At the heart of all of these negotiations is the fact that the writing profession is not financially tenable anymore. Our members have, for example, in television, seen their wages reduced by 24% in the last 10 years and features by 14% in the last 5 years, even though the companies are making hundreds of billions of dollars.
The Alliance of Motion Picture and Television Producers say member companies remain united in their desire to reach a deal that is mutually beneficial to writers and the health and longevity of the industry, and to avoid hardships to the thousands of employees who depend on the industry for their livelihoods. Patrick M. Verone helped negotiate an end to the last strike, which dragged on for 100 days. He argues this one is more critical.
We didn't even have the name streaming. In those days, Amazon sold books and Netflix sent out DVDs in the mail. In the 15 years since then, we've seen their business model evolve. We've seen it evolve on our backs, and the way that we've been paid and the way that you compare the way we were paid in the old days in broadcast and cable, it's inferior.
A big reason why writers say they remain united in their efforts, even if the financial hits pile up.
It is closing time here at Yahoo Finance Live. Here's a look at what to expect next week. On Monday, Apple's highly anticipated Worldwide Developers Conference kicks off at 1 p.m. Eastern, and many are waiting to see whether the tech giant will debut its augmented reality, virtual reality headset. And if it is announced, it will be the first new product category from Apple since 2014. Other updates we're expecting include new operating systems and Macs.
Plus, earnings season rolls on. Consumer names in focus. Smucker's, Cracker Barrel, and Dave & Buster's will give us some insight into how people are spending both in grocery stores and in restaurants. We'll also hear from Stitch Fix and Rent the Runway, which is in the process of navigating a turnaround. And meme trade favorite GameStop is set to report on Wednesday, June 7th.
And it is a relatively quiet week on the economic calendar as investors await the Fed decision June 14th. We will get readings on factory orders, services PMI, and weekly jobless claims.
That'll do it for us for now on Yahoo Finance. Thanks so much for tuning in. Have a great weekend. We'll see you right back here on Monday.